Hi, everybody. Come on in. We'll start in a few seconds. It usually takes a few seconds to get everybody in. Take it away, Monica.
Hi, everyone, and welcome to today's webinar. My name is Monica Bechtel, and I am with the New Mexico Small Business Development Center. Today, we have Tommy Thompson joining us, who is a certified SCORE mentor who specializes in business and corporate financial planning and business valuation. Tommy holds an MBA and is a retired CPA and will be presenting Cash is King, Cash Management for Your Small Business. Thanks so much for joining us. And without further ado, I will hand it over to Tommy.
Monica, thank you very much and welcome everybody. We're going to talk today about managing cash in your small business, and we're going to do that in a variety of ways. As Monica said, I'm a SCORE certified small business mentor. Over a 40-year career, I was a financial analyst, a CFO, a chief operating officer, mergers and acquisitions guy. My father-in-law used to say it was a terrible thing I couldn't hold a job. But for today, what I am is a cash management expert. For the presentation, if you would mute your audio, it should be muted when you came in. Make sure you set your zoom ratio to fit window. That will let you see the slides in their largest fashion and make them more easily to read. We'll be using the Q&A function to take questions. So if you would, write your question down in the Q&A, write down the slide number that the question refers to so that we'll be able to get back to that slide or at least understand what part of the presentation your question is about. So thank you for doing that. Now, you can get additional training offerings and additional consulting assistance beside this one at the NMSBDC website. That's at nmsbdc.org. There's a link there for training events. There's another link down at the bottom for counseling. You can get no-cost business counseling and also loan application assistance in completing a loan application at nmsbdc.org as well. So keep those in mind. You will get a copy of these slides after the presentation along with one of the presentation examples I'm using here, which will be live for you. So look for that to show up in your inbox and you'll be able to use those links to go straight to those events. Now, what we're going to do today is we're going to talk about cash flow management and record keeping. We're going to be talking about it from the standpoint of practical things that you can do. We'll answer your questions and we'll talk about next steps you can take to implement some of the things that we'll be talking about. Now, what we're going to talk about today is, first of all, what is cash flow? What makes it up? We're going to talk about strategic principles related to managing your cash flow. Among those are forecasting, tracking cash coming in, tactical means to increase and speed up your cash coming in, and tactical means to slow down your cash going out. Finally, we're going to talk about record keeping just a little bit. For those of you who've taken advantage of pandemic relief programs and things like that, those record keeping requirements are very important, and we're going to touch on those just a little bit. Now, if I can get the slides to move. There we go. First of all, when we talk about cash is king, we mean cash is king. Cash is the lubricant that runs your business. It is the thing that matches up between your customers' needs and your actual profit from serving those needs. When you run out of cash, that lubrication stops. And when that lubrication stops, you crash. So when you run out of cash, you crash. Keep that uppermost in your mind when you're thinking about cash management. And the reason that you should be keeping that uppermost in your mind is that cash really is the lubricant that runs your business. And you should be thinking about how any decision you make affects your cash flow throughout the business day, throughout your business career. Now, what is cash flow? Yogi Berra had a pretty good definition of it. He said, and they pay in cash. which is just as good as money. But for a more formal sense, Investopedia defines cash flow as the net amount of cash and cash equivalents. That's stuff that's so close to cash you can make it liquid immediately, that go into and out of a business. At the most fundamental level, a business creates value for shareholders by its ability to generate positive cash flow over time. More specifically, maximizing long-term free cash flow. That's cash flow that's not needed for any other purpose in the business. It's not needed to pay the bank. It's not needed to pay dividends. It's not needed to buy capital equipment. It's not needed to expand the working capital of the business, the amount that supports receivables and inventory and stuff like that. So with that definition of cash flow, we're going to talk about how to move it quickly, how to slow it down and keep it in your business as long as possible, because the more oil you have in the car, the longer it runs. Now, what makes cash flow? So our cash flow is comprised, as you might expect, of cash money coming in. And we'll talk about how the differences are between accounting profitability and cash flow positivity or negativity. Now, when cash comes in, it comes in over your counter as cash sales. It comes in as collections on accounts receivable if you do business on credit. If you offer credit to your customers, you send them an invoice, right? That creates an account receivable. Was that cash? No, it's not. But when they pay it, it's cash. Similarly, if they put money on deposit with you for some reason, a security deposit in a real estate business, a prepayment for services to be rendered in the future. Okay, those are cash items, right? So they're cash in your hand. You may have obligations related to that cash later on, but right now it's in the business. It's cash in hand. Also, cash money comes in from pandemic relief loans and grants, the payroll protection program, economic injury disaster loans, and so forth. Now, those come in, it's cash in your business, but again, there are strings attached to them that we'll talk about later. Finally, cash money coming in can include bank loans. All right, you have a responsibility to pay it back, but not today. But today you've got the cash in your hand, in your business. Similarly, you can whip out your checkbook and write a check to your business as a loan. All right, or you can ask your family and friends and fools to whip out their checkbooks and write a loan check to your business. There are obligations related to that, but it's cash in the business right now, and we count it as cash coming in. Cash money going out is the other side of cash flow, and that's all the things that you pay for to run your business. It's compensation, it's benefits, it's taxes, it's payments against accounts payable. Now remember, if you have credit from your suppliers, you get goods from your suppliers, right? You get an invoice with those goods. All right. The goods are as good as cash because you're going to turn around and sell them. The invoice, you have a few days to pay. You don't have to pay it immediately. Rent, cash flow out, right, to the landlord. Operating expenses, advertising, marketing, office supplies, vehicle expenses, you name it. Those operating expenses are cash out of the business when you pay it. When you pay it, remember, it's when the cash moves. Similarly, the obligations you have to repay bank loans are cash flow out. The obligations that you have to pay back family and friends and fools, those are cash flow out. If you have to buy capital equipment to make your business more efficient or to give you the ability to do things you can't do in-house right now, that's cash flow out when you make the payment, okay? Similarly, when you want to go buy groceries, if you're not taking a salary from your business, but you're taking a draw, then the owner draw is cash flow out. It's what's necessary to pay your own rent for where you live or your mortgage and buy groceries. So you can see cash flow coming in is different from accounting profitability. In accounting profitability, we only count the sales and the expenses, the income, the revenue and the expenses side of things. And those don't include things like the principal portion of bank loan repayments. They don't include things like capital equipment purchases, all right? They don't include the principal portion that you repay to family and friends and fools. Those things are cash flow, and they're accounted for as cash flow, but in a slightly different way than profitability. So cash flow has more sources of cash and more uses of cash than the accountants recognize in a profitability statement. Now, the accountants will recognize that cash moving in the balance sheet and the so-called cash flow statement that they prepare, but it's different from profitability. Now, what isn't cash flow? As I said at the start, sales on credit, when you make a credit sale to your customer, you send them the goods and send them the invoice, no cash has moved, has it? So that credit sale is not cash flow. Similarly, when you buy on credit from a vendor, you get the goods or the services or whatever you're buying, but the cash doesn't move yet. So cash flow doesn't include purchases on credit. Those are the so-called accrual aspects of accounting. And one more way that a cash flow is different, or a cash flow statement is different from a profitability statement. Now, the basic strategy for cash flow is to work at it. Number one, it's got to be in your mind at all times. How does this affect my cash flow? Has to be a thought that you have absolutely every time you do something related to your business. Now, it could be the sales aspect of it. It could be sitting down to pay bills. It could be any other time, but you need to be thinking about cash flow all the time. Now, once you're thinking about it all the time, the first thing you need to do, if you're going to try and affect the cash flow, is you got to figure out how much is coming in and how much is going out. And when is it coming in and when is it going out? And that's what forecasting is all about. And I've got a forecasting tool here for you in a minute that you're going to see that you're just going to love. Now, once we forecast cash flow, we're going to track it. The reason we're going to track it is because we need to see how it compares to what we thought was going to happen. And if it's different from what we thought was going to happen, and trust me, it will be different from what we thought was going to happen, then you got to figure out, why is it different? Is it a timing difference? It happened now instead of 3 weeks from now? Or is it a permanent difference? We didn't think about this in our cash flow strategy, and it's going to have to be taken into account when we revise and update our forecast. All right? And this is the process, because you're going to forecast your cash flow on a rolling basis going forward. You're not going to forecast it at the start of the year, then track it at the end of the year. That's too many. That's too long a period. For most businesses, you're going to forecast it over usually a month or a quarter, depending on your business activity, and you're going to track it the same way. I once worked for a business that did an awful lot of its annual volume in just a few months of the year. And we tracked our our forecast and tracked our cash flow every single day for those months of the year when we had a lot of activity. All right. Finally, once you forecast your cash, once you're tracking that cash coming and going, now we're going to talk about how we can speed up the cash coming in, accelerate it, and slow down the cash going out. Now, you notice I put a question mark after slow down cash out. Okay, I can hear you thinking now. That's easy for him to say. I can't slow my cash out down. Now, I'll show you how to do that. Okay, so cash flow strategy: work at it, forecast it, track it, and implement tactics that will help accelerate the cash coming in and slow down the cash going out. That's your strategy. Fairly simple. Now, forecasting consists of asking 4 questions. What's my cash right now? What do I have in the bank or accessible in my hands right now? Second, what's coming in? Why is it coming in and when is it coming in? All right. Yeah, I know it's 3 questions, but stay with me here. Third question, what's going out of the business? Why and when? And finally, when I net all that together, what's my cash at the end of the period going to be? Now, those questions are what you have to think about and put numbers to in order to get a cash flow forecast. Now, to do that, we have a model for you, a forecasting model for you. Now, you're going to get a live version of this spreadsheet in what comes to you after the seminar. But for now, we're going to talk about half of it, just the first 6 months, because otherwise the print would be too small to see. And this is why you need to fit to window for your slides, because this is kind of small type. Now, this template model helps you figure out what your cash flow is, because it starts with things that look quite a bit like a profitability statement, but then it makes adjustments to that. All right. And it comes down to the concept that we're going to create a cash flow from operations statement first. Then we're going to have a section of this that talks about debt service, another section that talks about capital expenditures, a final section that talks about the adjustments we make to what otherwise looks like a profitability statement to get a cash flow number. Now, normally with a profitability statement, the top line is sales, right? Right? How many of you have one of those? Don't all raise your hands at once. But here in a cash flow statement, a cash forecasting template, we have our beginning cash balance up here at the top line. Right? So we're going to start off January with $10,000 in the bank. Then we have the first section of what we're talking about here, which looks a lot like a profitability statement. It says we have sales on it. And that's all of our sales. This makes it easy. We have all of our sales there. And any other revenues that we have. We have a total. We have our cost of goods sold or cost of services. And we have a gross profit. So far, all looks like accounting, right? Then we have all of our operating expenses. Now you notice there's a few operating expenses that are missing in here. We don't have any interest expense in here, for example. We don't have any taxes. We don't have any depreciation on equipment, machinery, vehicles, and stuff like that. And we don't have any amortization, which is a fairly arcane concept related to bank loan discounts and goodwill and stuff like that most of us don't really have to pay attention to. So we make a total out of our operating expenses, and then down here at the bottom line, we have what is labeled EBITDA. Now that's explained over there on the left side. It's earnings before interest, taxes, depreciation, and amortization. And the EBITDA concept is that it's a proxy for operating cash flow. It doesn't have anything to do with our working capital changes or anything like that. It's just a proxy for our operational profitability, our operational cash flow that's related to our business activity. All right. Well, once we get there, you'll notice we come down, and at the bottom line down there, that's I got to get rid of this. I'm screen sharing. Got to back up. Whatever that number is down there. I'm sorry, it's blocked by something I'm seeing on my screen. And that number is our EBITDA number. Now, that's not our cash flow yet, because now we've got section 2, which is our debt service. Now, we don't care what part of the debt service is principal and what part of the debt service is interest. We just know that we've got a level payment loan out there that costs us $1,100 a month in cash. And it's going out, right? That's why the brackets are around it. And so that's our debt service section. And then the third section of this is capital expenditures. And again, capital expenditures are cash going out to buy capital equipment, which helps us continue doing what we were doing or helps us expand what we were doing, whether it's product line or depth or capacity for customers. So these two sections allow you to account for in your cash flow forecast what you expect to have go out of the business and when you expect it to go out of the business for those types of activities. Finally, we get to section 4, which is cash flow items and timing differences. Now here, we're going to add back the cost of goods sold. When we sold goods last month or in this month, we took goods off the shelf and sent them to customers. Those goods were there because we had spent cash to get them there before. So we're going to add back that cost of goods. Now, we're also, instead of cost of goods, we're going to take out the inventory purchases, and if you're in a manufacturing business, the cash you spent on salaries, wages, direct labor, indirect labor, factory expenses and things, the stuff that went out in cash. We're going to deduct that from our operating cash flow. Then we're going to do what seems counterintuitive. We're going to take out that sales number that we first put in up above. Remember, we go back up above here. Here's this $15,000 sales number. Now we're going to take that back out, but what we're going to substitute instead is the cash we collected at the time we made a sale. So if you have a sales counter and a cash register, it's the cash that came in when you made a sale, plus what people paid us against accounts receivable. All right? It's the accounts receivable cash receipt journal entry. Okay? Then we're going to talk about estimated tax payments. Any taxes we pay, which may have been accounted for in a previous period because we accrue them as the accountants tell us to. But in this case, we're going to actually make the payments in January and in April. We're also going to take out or adjust for the change in accounts payable. If I start the month, say, with $1,000 of accounts payable, that means people have extended me $1,000 worth of credit. If I finish the month with $2,000 worth of accounts payable, people have extended me more credit. And I've gotten more goods along with that extension of credit. So I've actually gotten more cash flow, right? Similarly, if I pay down my accounts payable during the month, right, so that I have $500 left at the end of the month, I've paid out cash to reduce my liabilities. And so we deduct the cash we paid out in excess of whatever the change was. Here, the change in accounts payable was it went down by $500 during the month, right? So that meant cash went out the door. Over here in March, it goes up 750. That means that we got 750 more credit than we had the previous month. And that works that way all the way across. There's a couple of other lines left in here for stuff that may apply specifically to your business. But we add up the totals for that section 4, and we find out that we've got $4,375 going out for the month because of those timing differences and other cash flow items. Now, we add up sections 1, 2, and 3, and 4, and that all nets together to $905. We add that $905 to the $10,000 we started with, remember? And we have $10,905 at the end of the month. Now, it just so happens that that $10,500 at the end of January is $10,905 we get to start February with. Okay? And you see how it flows. It goes month to month to month to month all the way across. And that is how this template works. Now, something I've added here for the slide. A lot of companies will set a minimum cash balance target. That means that they feel good, they feel better if they have a minimum cash balance. Sometimes the bank requires them to keep a minimum cash balance. All right? And so that minimum cash balance in this case has been set at $8,000. Now, that allows you to measure the cash that you have in excess of your minimum or a shortfall that you'll need to make up somehow. All right? In this case, it's a nice business. It's got positive cash flow all the way across the board, at least for the first 6 months. And the cash balance increases nicely across there. And our excess cash increases nicely right across there as well. Good business to be in, right? Now, we've forecast cash flow. When you fill out that template sheet, you will have a forecast of cash flow. The next thing to do is to track it. All of the major accounting software lets you create a profitability statement, profit and loss, create a balance sheet, and the third basic statement in financial statements is a cash flow statement. Now, you may want to format it. Sometimes you can do that. Some systems don't let you do that. But it will produce basically the cash flow from operations, debt service, capital expenditures, timing differences, and it will produce those 4 sections that we just talked about in our cash flow forecast. So you can compare those and see where your cash flow is varying depending on the section. Is it a shortfall in your operating cash flow? Is it a positive because you didn't buy a capital item that you thought you would? All right. You can see where it's happening. And that helps you go find out why it's happening, because you want to find out why it's different. Trust me, it'll be different. But you want to find out why it's different and then say to yourself, is that a one-time thing? Or is that a continuing thing because we didn't account for it in our forecast? So now when we update our forecast, we use the differences and the reasons for the differences to change the way we forecast so that we can then track from there and see what happens. All right. And over time, your forecasting ability gets better. Your tracking ability gets better. Your investigation ability into why these things happen gets better. And you can refine your cash flow so that you have a better idea that you're within a few hundred or a few $1,000s a month of where you want to be. I said earlier, track by the month. If your business doesn't have all that much activity, track by the quarter. All right, but track it in shorter periods than a year. Right now, in an emergency, and back 2 years ago when we started doing this program, we were in an emergency, the COVID pandemic. You might want to track it by week. You might even want to track it by day. As I said, one of the things we did in a business I was in the 80s was we put out a flash report every single day, and it had the budgeted number of sales, the actual number of orders we got. It had the actual bank balance for the day in it. And that kept everybody in the company got this, all the way down to the guys working on the assembly line. And it kept everybody focused on how the business was doing. It kept everybody focused on what we had to do to get orders in the door, product out the door, production made, and what the cash balance was. Because when the cash balance went negative, we started having to borrow money. We didn't like to do that. We did because we needed to, but we didn't like to. We didn't want to pay the interest expense. So that was for our normal, very concentrated time of year, right? But for you, in an emergency, you might want to know every single day what's going on. Now, how do you speed it up? Excuse me a second. The best way to speed up cash flow coming into your business is to go out and sell, sell, sell. Now, this isn't mindless. You don't go out and try selling a lot of stuff to people you haven't sold to before. You start with your existing customer base and you analyze that customer base, especially your best customers, the ones that buy the most from you. And you analyze what they've bought and when they've bought it. And you call them up and you say, okay, Mr. Customer, how would you like a deal? For the next 2 months or 3 months, I will sell stuff to you at a X% discount if you pay me with the order, or you pay me within 5 days of the invoice or 10 days of the invoice. Only then do you get the discount, extra discount beyond whatever we've done, but you get that discount. And basically you offer a pricing discount for fast payment or cash with the order, because that way they get a piece of profit margin. You're giving up a piece of profit margin, yes. That's the cost of accelerating the cash coming in. At the same time you're doing this, you don't stop prospecting and marketing to new customers. You might slow it down a little bit or spend a little less time on it if you're a one-man band. But you still have to continue marketing and prospecting to potential new customers, because a few of your old customers will peel away. Your customer base will erode over time if you don't replace it with new customers. Okay? Another way to speed up your cash availability is to use only one bank. A lot of companies, a lot of businesses have maybe 2 or 3 bank accounts in different places. Use one bank. It will get you faster availability because it comes into one bank and it takes a couple, 3 days before it's available to you. You transfer it to your operating bank, takes a couple, 3 days before it's available to you. If it all comes into your operating bank at once, then it's there and you only have one of those clearance periods to worry about. Finally, a way to accelerate your cash flow in is to borrow money, quite frankly. And when you borrow money, you want to match the type of the loan to what it's paying for. If you're a business that has inventory and sells on credit, you have the opportunity to take out what's known as a working capital line of credit. And what that is a revolving line of credit. The amount you can borrow is based on a percentage of your receivables that are less than 90 days old and a percentage of your inventory. Maybe a percentage is less than 90 days old too. All right, that's usually a smaller percentage. But though the combination of those two will give you some support for having put your expensive equity-based working capital to work in acquiring that inventory and in extending the credit for that, right? Similarly, if you're borrowing to buy a piece of capital equipment, you might take out a term loan that stretches out over some portion of the estimated economic life of that equipment. If the equipment's life is 7 years, you might take out a 5-year loan. 10 years, you might take out a 6 or 7 year loan. All right. There's some value there once the loan's paid off. And that is a fixed credit, right? It doesn't revolve. It doesn't go up and down as your receivables and your inventory go up and down. So that's another way to bring cash into the business a little more quickly. Now, when I say collect receivables faster, you say, huh, how do you do that? Well, there is a very, very professional set of methods and techniques in the credit management world that help you collect people's money faster. And first of all, it involves analyzing credit up front, but we're not going to talk about that today because you should have already done that. But if you want to accelerate your receivables, again, you look at those customers. You divide them up into A-class customers, B-class customers, C-class customers. Basically, based on how they buy and how much they buy, when they pay you and how much they buy. For example, the guy that buys a little bit from you every so often and then doesn't pay you for 90 days, you might reduce his credit line, his open to buy line. You might reduce it and say, I'm not shipping you until you've paid XYZ, okay? Or you might put them on credit card status. You might say, I can't extend credit to you anymore. I will take a credit card with the order. Then your better customers, you want to give them a call. You want to call, follow up. You're expanding on the relationship you've built with them through the selling process, the marketing process, just to see how their business is going. It's all very soft. It sounds soft too, doesn't it? But what it does is it puts you at the top of their mind when it comes time to pay bills. You call and follow up. You call and follow up. You know, the week before the invoice is due to be paid, you call, hi, how you doing? How's things going? How's things happening? Do you foresee any issues with perhaps getting our payment out next week? You know, because it's not tomorrow, it's next week, because you're calling them a week ahead of time. So you're giving them time. You're giving them time to put you at the top of their mind. All right. Now, you could also, as I noted in the last slide, you can use revolving lines of credit. You send them the invoice, and then you apply to the bank because you supply the invoice to the bank, and the bank will advance you a little bit more money. There's also a version of revolving lines of credit that's called factoring. And I say it's a version because in effect, you're selling your invoice to the factoring company. So you're getting paid quickly, sometimes within a day or hours, depending on your relationship with the factoring company. The downside of it is it's much more expensive than a traditional bank loan because that factor is not only providing you time because you're getting paid now instead of 30 days from now or 50 days from now. They're also taking the risk of payment on themselves, all right? Because you're selling them the invoice. Now it's their job to collect the invoice. You're done with it. So they charge you for that. Factoring is something that's very common in businesses where there's a big seasonality, for example. In the fashion business, right? A fashion producer, a sewing shop, a boutique, a line, has to send all their fall collection out in late June, July, early August. The department stores they sell to, the boutiques and the places they sell to, don't pay them until like Christmas. So factoring there gets them money quickly in order to pay their bills and keep the doors open until the season changes again and they go back to it. Also, you can accelerate cash in depending on how much you're talking about by using a lockbox service. Normally, a customer would send you a check and payment. You process that check in your accounts receivable department. It takes a day, and then you take it to bank. Well, in a lockbox, the bank gets the check first. They deposit it so that the clearing process starts, and then they send you the payment remittance information that came with the check, and you can process it at your leisure. But that clearance process starts a day earlier, or 2, 3 sometimes, depending on how your receivables process works. Okay? So those are some ways to accelerate the stuff coming in. Now, how do you decelerate? How do you get cash to go out of the business more slowly? And it's basically the same thing we do with customers. You take a look at your vendor list. You break it down into A's and B's and C's. Your A vendors are the people you absolutely have to stay in business. You absolutely want to treat them as well as you can. Okay, you absolutely want to stay within terms with them. You want to be a good customer for them. All right. So you're going to prioritize those vendors. The B vendors are people that, well, you could get along without them for a day, a week, or two, a month. The C vendors are people you can get along without, maybe period, but at least they're not as nearly as important to keeping your doors open. Now, the key to all of this is that once you've prioritized your vendors for payment, you communicate, you call them, you tell your story. You call your A vendors and say, here's the situation I see. My cash flow forecast says, okay, that I'm going to need a little time from you over the next 3 months. I want to delay and go to 45 days or 60 days for the next 3 months, and then I'll catch up over a month or two after that. All right? First of all, when they hear you say, my cash flow forecast says, they automatically increase their respect for you because you are paying attention. You are thinking forward. You're being proactive about your business. That's being a business person. When you ask them for relief, you're basically the same message. It's a delay and a catch up later. All right? But you got to tell the story. The story is, I see this happening in my local market. I see this happening in the national market. I see this happening and I want to get ahead of it. So I know that my cash flow forecast says that in 2 months, I'm going to need some forbearance from you for 3 months or so. Okay? But communication is the key. Just like you communicate with your customers, you have to communicate with your vendors. The worst thing you can do with a vendor is after having been within terms as a good customer, bang, 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 all of a sudden they don't hear from you for 3 months, 90 days. Okay? They get very nervous when that happens. But if you're talking to them, they don't get as nervous. Now, cut expenses. That's part of decelerating cash flow out. And yes, it's easy for me to say. But again, we do the same thing we did with our customers. We do the same thing we did with our vendors. You analyze your expenses. You analyze your expense ledger carefully. You analyze your payroll carefully. You look at where you create value for your customers. What part of your business is it that customers come to you to get? All right? And absolutely everything but that function, you can probably outsource to somebody. Maybe for less than you're paying now, but you got to do the analysis. All right? And once you've done that analysis, then you can say, here in my expenses, I can do without this conference for 6 months. I can do without this training session for staff for 3 or 4 months. I can do without this for 2 or 3 months or 4 months. And you take those actions because you've analyzed your expense ledger. Same thing with your payroll. And I will tell you, as someone who's had to hire and fire, it is the most difficult thing in your business to say to a good working person, a good person who's doing a good job, that I'm sorry, I don't have a job for you now. It's extremely difficult to say, but it may have to be said in these cases. Now, some of your full-time people, maybe you can put to part-time, maybe for a while. Maybe you have to release them, maybe for a while. Maybe you can get them back, although what we're seeing right now in the marketplace is once they're gone, somebody else has hired them. So be very careful about that in this market. Then you can always decide that there are those things you're going to do without. I'm sorry, we're just not going to go to conferences anymore, foreseeable future, right? But the one thing you don't do without is you don't eliminate marketing. I said that before. I'm saying it again here. You have to find new customers to replace old customers who fall away, who peel off. The competition gets to them, okay? They go out of business, they retire, they die. Happens. But don't eliminate marketing to get new customers for those folks. Now, what do you do in an emergency? In an emergency, all bets are off, okay? And you really have to bear down. And the whole key here is to communicate, tell the story, negotiate with your vendors. I need more time. I need this open to buy. I need whatever it will take to stretch your vendors out. Delay, catch up later. Delay, catch up later. Delay until you get a pandemic protection plan loan. Okay? Delay until you get an EIDL loan and then you can bring them current. Same thing with your landlord. If you have a lot of time left on your lease, your negotiation is more like, can I reduce my rent and catch up over the balance of the lease term? All right? Delay and catch up later. Same thing with the bank. Can I get some forbearance for a month, 2, 3, and catch up over the term of the loan, or catch up over a 2 or 3 month period if I'm bringing a revolving credit line back into terms. All right. Decelerate as much as you can. Negotiate. Again, tell the story. You have to be able to talk to your vendors, to tell them the story, to tell them what's happening, to tell them what you're doing about it. All right. And remember, use my cash flow forecast says all the time, because that brings in the fact that you've been proactive, that you're looking at this at more than just what's happening this morning. All right. And people will respect you for being a more forward-thinking person. Accelerate. Go to your customers. If you're a service business, go to your customer and say, you know that service contract that we have? How about renewing it now and I'll add an extra 3 months free? Same thing with subscription type services. Renew it now and pay me now and I'll give you an extra 2 months free or 3 months free. Gift cards, get the money now, provide the services later. This is especially popular with restaurants. If you're working under a contract with someone or you're entering a contract with someone, look for and request in the contract an advance contract payment that you work against during the period of the contract. But it's cash now. It helps you, and it's perfectly okay to ask for it because you may have some costs in setting up to fulfill that contract. You might need a new vehicle. You might need a capital item. You might need supplies brought in. That advance contract payment, and you bill against that advance through the end of the contract, that's perfectly okay to ask for. Disaster relief loans give you an acceleration. The SBA makes economic injury disaster loans directly, all right? And they're a program that was here before the pandemic, it'll be here after the pandemic and everything else. The state of New Mexico, if you do some Googling around, various states and even the city of Albuquerque have some business grant programs related to the pandemic. We're coming out of the pandemic, they're less available than they were. For example, I don't think you can get a payroll protection plan loan anymore, okay? But keep those in mind, investigate them, go look for them, right? If you do take advantage of any of those programs, you do have to keep good records, because we're just seeing now the impact of the feds coming back to borrowers under the PPP, coming back to other pandemic program grantees and things, and saying to them, okay, we gave you X amount of money based on your request, based on your calculations, prove it to us. Show us your payroll reports, show us your vendor check report, show us your actual receipt for the payment, okay? You need an evidence of payment, your canceled check, for example. All those programs had different requirements. And you've probably heard on the news a couple weeks ago that there was a big brouhaha about how much had been lost to fraud in the program. And they had an item that said it could be several billions of dollars, tens of billions of dollars. Well, there are 1,000 billion in a trillion. And we spent about $3 trillion getting us out of the pandemic recession. So 3,000 billion. So 10 or 20 or 30 of that, it's 1% of the program. Now, as a policy person, I'm not too excited about that. As an auditor for the federal organization that put that money out there, I'm really interested in it. And I don't want people committing fraud on me. So they're going to come back and start auditing people who receive these things. Keep bookkeeping records. Keep your basic bookkeeping up to date so that you could pull a profitability statement tomorrow and it would be reasonably up to date. All right. Beyond the bookkeeping, all that underlying original entry material, payroll records, leases, utility bills, invoices that you've paid, any evidence of payment or receipt is necessary in that stuff. Work with your CPA or your bookkeeper to set up your books properly, to set up your filing system for original entry documentation properly, and work with them going forward to make sure things stay up to date. You don't have to do this alone. There are people trained to do it who can work with you to do that. All right. And they're the people who you can depend on to be current and be up to date with those programs. And ask them before you engage them, or ask them if you've been working with the same person for a while. Ask them, did you train in this? Do you understand what's going on? Do you understand what the reporting requirements are? Let's get going on this. Okay. Now, we have a number of resources that went into building this presentation that you can go look at yourself. I'm not going to go through them in detail, but they're here in the slide copy that you're going to get. There's also resources for continuing pandemic activities, COVID safe practices, guidance on preparing workplaces and cleaning, general COVID-19 information, how it interacts with the ADA, and so forth. Excuse me. I'll leave that there for you to pursue in detail. And also, for questions, you can contact the SBDC either through their website at nmsbdc.org or for the phone numbers that you see there. Their email is info@nmsbdc.org. The sba.gov website can answer a lot of your questions. There's a lot of resources on there if you Google around inside it. The 800 number gets you to the Economic Injury Disaster Loan people. And that email, their disaster customer service, gets you to the same people, the Economic Injury Disaster Loan people. And you can pursue them from there. Now, recognize that they get a lot of calls. It may be difficult to get through to them the first try on telephone. An email sits there until somebody does something with it. So that's probably one of the better ways to take care of it. Now, I've talked fast and I've talked a lot here. I want to add some acknowledgements. The person who gave me that wonderful spreadsheet template was a man called Philip Campbell. He's the author of a book called Never Run Out of Cash. The website's easy to remember. It's neverrunoutofcash.com. And you can get a live copy of that template there or wait for the SBDC folks to send it to you. The National Federation of Independent Businesses, or NFIB, has a lot of material on its website, and we used some of that material for this program to develop it. Inc. magazine has a large archive of articles and so forth on a variety of topics on their website. And then finally, some of the resources from the SCORE Association's Albuquerque chapter, which I'm a member of, We want to thank them for their willingness to cooperate as a partner with SBDC in putting together this seminar and the presentations. Now, I've talked fast for quite a while. I'm interested in whether you were listening at the same speed I was talking. So any questions that you have, if you just jot them down in the Q&A box there down at the bottom of your screen, we'll be happy to look at them. And thank you for your attention for that period. I'm going to look at the chat box here just for a moment and bring everybody up. The webinar folks, Sandy Jones says thank you. And there's more information there in the chat box. You can copy that out and paste it into a Word page or something if you want to keep it, because it will disappear when the seminar ends. So we're open for questions. Raise your hand or just tap out, tip, 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 tap, 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 type, and we'll be happy to answer them. I'll give you a few seconds to do that while I get some more of the elixir of life here. Trust me, it's mineral water, not beer. That's for later. You're very welcome, Jile. I'm looking at more chat stuff here. Haile more? I don't know how to pronounce it, but thank you. You're very welcome. Okay, question. Can you explain more on owner draw? And I will answer that. Sarah Thomas is asking the question. Thank you for the question, Sarah. Owner draw is cash that you take out of the business. It's cash that the business should be cash that the business doesn't need to run, but it's also the cash that you use to buy groceries. Now you can take the cash out of your business two ways. Three ways, actually. First way is to pay yourself a salary. Put yourself on the payroll, and get a payroll check every week. That's part of your operating expenses. It's a valid expense because your labor, your management skill, your ability to operate the business has value. All right. The second way to take cash out of the business is to simply write yourself a check and call it owner distribution or owner draw or whatever. Now, the payroll way to take it out takes care of all the payroll taxes for you. In other words, the check that you write to the payroll service provider has the total cost of the payroll plus the service provider's fee in that check. All right. So your withholding is taken out and sent to the feds by the payroll service. The payroll taxes that are due are calculated and added to the payroll and sent off to the proper authorities at the proper time. When you write yourself a check from the business bank account, none of that happens. And you've got to calculate and perhaps pay estimated taxes on what you drew out. Okay? So keep that in mind. I said there were three ways. The third one is at the end of the year, you reckon everything up and find out that you've got money left over. Hooray! It's a wonderful thing, right? And similarly to writing yourself a check periodically through the year, if that's how you're doing it, you write yourself a check at the end of the year. Now, you still owe taxes on it, right? So a partner and I owned an LLC during the 1980s, and we were a consulting firm, and we paid ourselves a salary twice a month, twice a month, twice a month, twice a month, twice a month. And at the end of the year, we've settled up, so to speak, in that we created the partnership tax return and the partnership K-1 forms, and those told us how much money, more or less, we had to report on our tax returns. Every once in a while, we wrote ourselves a check to pay for the taxes. But that money at the end of the year, we made sure that we adjusted our salaries and our withholdings during the year. So at the end of the year, the profit was fairly small. We didn't have a big tax bill to pay at the end of the year. Okay, follow me? So that's the owner draw idea. You can draw money out of the business, but you still owe taxes on it. Or you can take a salary out of your business through the payroll process. I hope that explains your what you were looking for. If it didn't, raise your hand and keep writing the questions, and we'll address it some more. So, anyone else with questions? Oh, don't everybody talk at once. My goodness. Well, look, I want to thank you all for your time today. I appreciate it. I enjoy doing this sort of thing. If you liked it, this was an NMSBDC seminar on Cash is King, and my name is Tommy Thompson. If you didn't like it, this was Bookkeeping 101, and my name is Mortimer Snerd. But before we go, I want to point out a couple things, provided I can get the slide to move. Hello. There we go. What's next? Now, this seminar is useless unless you take it to heart and go do something about it. And what you can go do about it right now, or tomorrow morning, maybe it's 5:05. Tomorrow morning, you can start by building your cash flow forecast. Build your first one. Just sit down and do it. Don't worry about whether it's good or bad or indifferent or anything. Just make it. Build it. Use your prior financial statements and things to pull numbers from, to put together an initial forecast. Initial forecast. That's your draft. That's your prototype. That's what you're working from. And then next month, you start updating it. You start updating it and updating it for whatever is different from what you assumed was going to happen. And that gets you on the road to forecasting, tracking, understanding why your cash flows the way it does. That's what's next for you. And that's what I want you to take away from this seminar, is to get moving, get doing, and get working on managing your cash flow thoughtfully and proactively. Now, I'll say again, you can go back to the New Mexico Small Business Development Center .org website, nmsbdc.org, for more training opportunities. You can get counseling for your business at no charge. You can get loan application assistance. They have links to a variety of other business resources. All right. Also, and please, when you get this, please fill it out and send it back. You're going to receive a survey by email after this presentation. And I really do value your honest feedback from this, because your feedback goes directly into helping improve this program. And I really would like to see those survey results from everybody here today, because it does help. It does help me understand what I've done well and where I need to improve. So thank you for that, and I appreciate it greatly. If nobody's popped up another question, and I'll go down and see if I can find it here, and I don't see any more questions, in that case, that's it, folks. That's all. Monica?
Well, thank you for the presentation and valuable information, Tommy. It was great. I learned a lot of new things. So thank you also to all of the attendees, and have a wonderful afternoon and week ahead. And please don't forget to visit our website at nmsbdc.org to view our upcoming no-cost webinars, or to sign up for our no-cost counseling services. The NMSBDC is here to help you during any stage of your business, so don't hesitate to reach out to us. Thank you.